Hey everyone, welcome back. So in today's video, we're going to talk a little bit about interest rates and how they can affect the bond portion of your portfolio, or that protection piece. Now there's a lot of different types of fixed income instruments out there: corporate bonds, government bonds, municipal bonds, CDs for that matter as well. And in the current interest rate environment that we're in right now, if we see interest rates start to creep back up, there's some things you want to be aware of in terms of how it can affect your overall portfolio. So one of the biggest levers that the Federal Reserve has to pull during a recession is to hold interest rates artificially low. And there's a lot of different ways that they do this, but the key takeaway from that is holding interest rates low, in theory, stimulates the economy. A lot more lending activities going on. People can go out and borrow money, refinance existing mortgage debt that they have at a lower cost. So interest rates have been held low for quite a while. There's really only one direction for them to go. Whether it happens in 6 months or in 6 years, interest rates are expected to tend to creep back up over time here. How that affects you and your portfolio is important to be aware of. So just for argument's sake, let's say you go out and buy a $1,000 bond. So a bond is a little bit different than owning stock in a company. With stock, you literally own a piece of that company and you get to benefit as the company does well. Your share price appreciates. Maybe they even pay a dividend as well. Compared to ownership, owning a bond is lendership. You're lending money to a company for a certain amount of time. They pay you a little bit each year, and by the end, you get back hopefully what you started with, as long as the company's still in business. So let's just say, for argument's sake, you go out and you buy a 10-year bond. At the end of the 10 years, you get your $1,000 back. And let's say right now, you're able to go out and find a bond that's going to pay you 3% a year. So each year, you collect $30 then. And it actually is what's known as a coupon payment. Back in the day before technology, they would mail you a book of coupons, and when you needed to redeem, whatever that quarter or annually, semi-annually, depending on how frequently the bond pays, you'd clip out your coupon, you'd send it in, they'd send you the check for, whatever they owe you. And it's still known as that today, believe it or not, even with technology, even though it all happens digitally. So you clip your coupon for $30 a year. So let's say you're 3 years in, you've collected your $30 a year, and interest rates go up. So the same risk, everything else is equal in a vacuum. That same company is now going to issue new bonds at 4%. Well, it's an easy math problem. Do you want the one paying you $30 a year or $40 a year? Of course, you want the one paying you a little bit more. So the way that the math works for you to go sell the bond that you currently have now, redeem that, and go purchase the other bond and reinvest at a higher interest rate, to boil it down, there's a lot of other extraneous things that can impact this. But just for argument's sake today, they went up 1%, and we still have 7 years on our maturity here, right? So the way that the math works, 1 times 7, your bond that you paid $1,000 for, you would have to take a 7% haircut, sell it for $930 to be able to go out and buy the one paying you the higher interest each and every year. Or you could just hold the bond you currently have for the next 7 years, collect your $30, and then reinvest at that point. So the key takeaway with this, and this is what is known as duration risk. The longer term the bond, so if we did the same math on a 20 or a 30-year bond, and interest rates go up 2 or 3% over that time frame, it's going to be a much more substantial haircut that you're going to have to take to be able to redeem it and reinvest. So there are a few ways that you can combat this duration risk if we do expect interest rates to go up. One of them, just owning shorter term bonds. So in the same example, if we owned a 2-year bond, we could either reinvest and you'd only have to take a much smaller haircut at that point, or you could just wait 1 more year and reinvest at that point. So rather than taking your whole protection piece or shock absorber piece of your portfolio and throwing it in bonds that are going to pay you the most right now, it might be more prudent to develop a diversified strategy where you're not essentially trying to call your shot either way. So it could be owning shorter term bonds. It could be by way of owning higher yield bonds, where if they're paying you a little bit more on the front end, it can act as more of an absorber to that interest rate risk as it creeps up. Another prudent thing to look at would be to possibly allocate a portion of that part of your portfolio to inflation protected bonds, where if we do get inflation, the metric that they use to pay the interest each and every year is actually tied to inflation. So building out a diversified portfolio on the bond side is no different than on the stock side as well. So hope this video has been informative. If you do have any questions, please reach out. But otherwise, stay the course.